have in place. Things you should have in place. We know we're at the top of the year, and so we want to talk about the things you should have in place. And I know Minerva, she's going to hear some of this, and it won't be her first time because we've explored a lot of this, but some people overlook these important steps, all right? Important steps. And I wanted to make sure I recap them. Some of you may need assistance with them. Some of you may need my support in executing or creating them. And so I want to show you that as we go on in today's lesson. But before I get to that, for most that will hear this, those that are on live, those that are watching on YouTube, those that are on Zoom or watching this replay, most of you know that I'm also a pastor. I've been in ministry since 1995, believe it or not. Can you all believe 29 years? That's a long time. And it'll be my 30-year anniversary in ministry in May the 21st. So,
oh, wow.
yeah, so that's pretty awesome. So it was really placed on my heart to do something that I started a long time ago. So over 15 years ago, I started a Christian education and leadership program called Journey. I incorporated at the church I pastored, and then when I joined the Kingdom Church, I also incorporated this same program at the Kingdom Church, and we graduated hundreds of individuals through this Christian education and leadership program. And so I decided, hey, let me do this again. We hadn't done it in years. And so it really was placed on my heart to do it and then open it up to others that maybe want to grow in their relationship with God, those that want to get closer to God, or those that are looking to sharpen their leadership skills. And so you'll see me advertise this a little bit on social. I'm not really doing any sponsor ads, so you're going to see only organic information. So you may or may not see it depending on if I'm in your timeline feeds. But ministry and marketplace, I'm big on that, being able to understand, hey, not only has God given me this gift for the marketplace, but I also have a gift in ministry. And so really it's an 8-week course. It is graded. So what I found about that is that it's going to push you. So some of us, I don't know if you're like me, but sometimes if you read the Bible, you find yourself falling asleep. Or if you're praying, you start yawning. It's like, where did that come from? I wasn't yawning before. It's some people can call it that's a spiritual battle. Some people can just say, hey, I'm just not disciplined. I don't know, whatever the reason. Sometimes we need additional accountability. Sometimes we need an additional push to kind of get closer to God and grow our relationships. And so I got an 8-week course. It's very inexpensive to join that program, but it's an 8-week course. Holistic development is going to give you academics, which means I'm going to cover specific topics like servant leadership. What does that mean? Time management. For most of you all, you already know how to start a business, but you'll be surprised how many people that don't. So I'm dealing with a variety of aspects, and it's very holistic. Physical development, character development. Most people don't realize how important that is. In-reach and outreach when it comes to church. So the things inside what we call a weekend service, how to operate in maybe other teams or departments within the church and do outreach as well outside of the four walls of the church. So if you're looking to advance your leadership skills or be more spiritually in tuned, this may be for you. And I think Minerva, is this the link that you clicked on? I saw an email just now. You said you clicked on the link and paid. Okay, so that's what that was for. And so,
I
okay.
It was meant to happen.
Okay.
I'm realizing that right.
It was meant to happen. Okay.
Yeah.
Okay.
100%.
Awesome. So there's a couple things just so you will know. Those sessions will be on Thursday nights live at 8 p.m. But once you register, you'll have access, and all the videos and all the recordings will be in the portal for you, and will be important for you to watch those in case you do miss it. Most importantly, if you're able to show up live, you're able to get the Q&A and really glean and understand, and most importantly, focus. You know, sometimes we watch videos, we're multitasking or doing other things, and so our minds are not really focused. And so if you want to join me live, we're starting February the 20th, which is next Thursday night at 7, not 8, 7 p.m. I'm going to get that time mixed up sometimes because we usually are doing something else at 8, but 7 p.m. So Thursday nights, 7 p.m. starting next week. All right, so if you want to sign up for that, please, if you would, send it out to your friends, family. Say, hey, you all, if this is something you're looking for, I promise you, I not had one person ever complain other than, man, it's some work to do. Other than that, you won't hear no other complaints. And I have everyone else highly recommends this program. All right, so I'll put this up on the screen for you one more time. You can use my short link, pmdy.link/journey. All right, so I'll let you all grab that. So thank you for signing up for that, Minerva. All right, so let's get into the meat and potatoes today. There are some must-haves as we move forward. We're at the top of the year. We're in February. First quarter is already almost over. So what's those must-haves? Number one, we have to have the strategic planning for growth, right? Minerva knows that's like my hot button. We got to have a strategic plan in place. Okay, how are we going to get to that revenue? Because a lot of us can state revenue goals. Oh, I want to do $1 million. I want to do $2 million, whatever. But okay, how are you going to get there? What's your strategy? What are the steps to get to that number? And so we have to have a strategic plan. Number two, if we're going to grow in that way, are we ready? Do we have the financial capabilities, and are we budgeting towards it? I'm going to show you towards the end of today's session kind of how I had one of my biggest years and actually had a deficit. One of my biggest years and had a deficit. I'm going to show you that towards the end of today's session. But having financial readiness and also have a budget so you can project, am I going in the right direction? See, it's great to have a strategic plan, but what tells you you're on course? What tells you, okay, we're making the right steps? What tells you at the end of the first quarter, we're in the right position? What tells you at the end of the third quarter, are we actually going to hit our number or are we way off? So some people say, know your financials. Yes, that's right. But having a budget to go along with your financials is important. Having a budget to go along with your financials is important. I'm going to show you all one of the greatest mistakes that I made when it came to our financials, because I had a CPA, I had an internal bookkeeper, I had all that, but oftentimes I did not have an annual budget. An annual budget. Are y'all with me? And let me say that again. An annual budget. Right? So for me, Minerva, on the construction side, I had budgets for each one of my projects. So when we did our estimate, we were able to say, okay, this is how much this job's going to cost, and we would track the cost for a project. But I didn't have an annual budget. And so when it came to the end of the year, I kind of could tell which direction we were going just by looking at our project numbers, but our overall numbers, I often misinterpreted or misprojected my overhead expenses, my administrative expenses. I'm going to show y'all that later. Okay, so must have strategic planning for growth, financial readiness and budgeting. Here's the third one, team alignment and execution. Team alignment and execution. Do I have the right people on my team? All right. Do I have the right people on my team, and are they in the right seat? Do I have the right people on my team, and are they in the right seat? What do I mean by that? Okay. Because you can have a great employee, but if you have them in the wrong position, it still can be a disaster. Right? I can have a great employee that's good analytically, they could, do the checks and balances. Maybe they're great with customer service, but they're not good at sales. And regardless of how much training I give them, they're still not able to develop sales. But maybe they can manage operations. So some of us will make the mistake and say, this person is not performing, and we'll let go good people. Here's another scenario I've ran into. We'll have people that's loyal to the company, but it seems like they have limited capacity to grow. They have limited capacity to grow. And I'll say this, and I want you to hear me clearly. One of the largest mistakes I made in business was allowing someone that had loyalty be discredited as not being a good employee, or not being able to see them remain in the company though the company was growing and they were not. I'm going to say that again. The company was growing, but they weren't growing, but they were loyal. This is a quality that has no salary cap. Because it's so hard, it's nearly impossible to find loyal people. And when you find one, you got to say, okay, they may not excel at this thing or that thing, but where do they fit in the organization? Because I promise you, they fit somewhere. And it's better to have loyal people than a bunch of skilled, unloyal people. All right, so I want you all to get that. Let me keep going before I run out of time. All right, the fourth thing is marketing and client acquisition. So this goes with our strategic planning, but it's a little different because in order to develop a strategic plan, you need to have a marketing plan that tells you how are we going to capture the clients, how are we going to get the leads, how are we going to build our customer base, right? So that's a part of your strategic plan, but it is a sub part. So what is your marketing plan? How are you going to get clients? How are you going to acquire new clients? So not only acquisition, but if I could add this other word, and I know Minerva knows it, retention. So we should be checking our KPIs when it comes to new acquisition and also retention, okay? So let me give you this. I'm going to go real quickly and get to some of the meat and potatoes that I want to talk about today. So let me give you a reminder. You should know your numbers without relying on the amount in your bank account. You should know your numbers without relying on the amount in your bank account. So I know many people have made this mistakes before, thinking, hey, I have $10,000 in the bank, I'm good. Anybody done it? Who would admit? I know it can't be just me. Who would admit I made this mistake before? I have $10,000 in the bank. I have $50,000 in the bank. What's up, Giselle? I have $50,000 in the bank. I'm good. And some of us will make this mistake by trying to manage what we have in our bank account, what it says on our bank statement, versus having a financial statement. Why? Because for most of us with service-based businesses, we should be on accrual accounting. Not all of us, but most of us will be on accrual accounting. That means if I'm providing services and maybe have to send an invoice to get paid and I have to wait on payment, I should be on accrual accounting, not cash accounting. And what happens is I may have bills I have paid or bills I have to pay in the future that I don't account for in my bank account. I can only account for it on my financial reports, okay? So that's really important. So remember that. I'm going to say it one more time. You should know your numbers without relying on the amount in your bank account. So the first step, and one of the first steps we want to make sure we make is ensure that you have the proper income statements coming in. They should be showing your sales revenue, your cost of goods sold if you're in construction specifically, or a specific service-based business. So any of your costs associated with exactly what you do normally goes into cost of goods sold. You have your gross margin, other expenses. That could be your overhead costs, right? Your office expense, your power, telephone, cell phones, insurance, etc. And then you have your net income, okay? I got to pull up one file because I want to show you all something that I really wanted to pinpoint today. And I just want to pull up that slide real quickly. Anybody have any questions so far? Any questions so far? because I forgot to put this slide in. Let me put it in real quick. Any questions so far? Nope. What's often found in our financial statements is called a chart of accounts. Chart of accounts. If you're familiar with this, drop a yes in the chat. If you're familiar with this, drop a yes in the chat. If you're not familiar with this, drop a no. Drop a no. If you're not familiar, drop a no. Let's see what we got. If you're not familiar, drop a no. I don't see any messages in the chat. If you're familiar with this, drop a yes. Not familiar, drop a no. And so your chart of accounts is how you label each account on your financial statements. And so it's really important that your CPA does this correctly. I've had several clients, especially in 2024, that was like, hey, I realized I found out that my CPA really wasn't coding my costs to the right categories. And so it all starts with making sure that this is set up correctly. Most times as you start growing in business, especially if you're using a software like QuickBooks, you have to pay a little bit more to add the actual numbers in front of your chart of accounts, the actual numbers. So you see here on this slide, commonly accepted order is 1,000 to 1,900 is assets, 2,000 to 2,900 is liabilities, 3,000 to 3,900 is equity, and so on. So normally you will see your expenses anywhere between 5,000 and 7,000, and they use those codes in front of your actual description of that account. Okay, and I'm going to show you an example of mine that I use in just a second, okay? So,
Hey, Michael, so sorry. What do those numbers mean? Is that like a IRS code?
no, it's just
like
it's just a prefix.
Okay.
It's just a prefix. And
But is that standard, like a standard used by like
yes,
CPAs?
yes,
Oh.
yes.
Okay, I gotta find that list because we have chart of accounts, but I don't know that we have this code in front. Like,
yeah.
We spent actually a lot of time last year identifying all of
right
our categories.
And
yeah.
that and,
okay,
and you know, I remember, you know, where you were, and I applaud you for getting that set up, because that's where it first starts, making sure we have everything itemized correctly, everything coded correctly first. That's where you have to start, because regardless what the prefix say, you have to know where everything is coded. Why? Because you are developing what we call cost history. You're developing cost history. Now, I'm going to show you in a second, that is the way to set up budgets moving forward. And I'm going to show you that in just a second, okay? So, as Minerva mentioned, those codes, those numbers are only a prefix. And it's a prefix that most licensed CPAs recognize, okay? Now, do you have to have them? No. But does it make it easier for someone, any CPA, to read it? Absolutely. Right? So they understand, you know, what that prefix really is, regardless of what you name it. They kind of understand that prefix. So they coincide together. But anyway, that's how I was taught. So I want to continue to share the knowledge. All right. So let me just show you what's important, because my first reminder was do not manage the amount of money you have based on your bank statement. Manage it by your financial statement, right? Not your bank statement, but by your financial statement. Step number 2, I want to show you how having an annual budget helps prepare you for everything else. Having an annual budget helps prepare you for everything else. Okay, So let me show you some steps. And I'm going to let you take a picture. For those that are not in the mentorship, you all can take a picture of this slide. It'll also be on YouTube if you need to go back to it, okay? So here's some steps. Number one, you need to look at your prior year profit and loss report. Your prior year profit and loss report. Prior year profit and loss report or income statement is same report. You have to have this set up first. Now, just like Minerva alluded to, if your report is not set up correctly, it will be hard to have a baseline. It will be hard to establish a baseline to move forward. That means, let's say, for instance, I had one client, they had their CPA, not even them, their CPA had their payroll costs categorized in like 3 different areas. I was like, that doesn't make sense. And we want to make sure that there is a reasoning behind that. If you do need to do it that way, there's a reasoning. Now, our church, we use primarily 4 different payroll ledger codes to categorize certain types of expense. So we'll have office staff, we'll have ministerial staff, I think we have like facility staff, and also I think like production or something like that. I forget. But we kind of categorize them separately because we want to manage and track those specific costs each and every year. Now, if you're in the construction industry, any payroll associated with a project should be part of your COGS, cost of goods sold. Now, some of you all may not be in the mentorship. I did a detailed breakdown of this in an accounting session that I did last year. So that's up in our portal. If you do watch this on the replay, it's in our portal from 2024 on accounting. Okay, so if you want to go back, check that out, because I'm not going to spend a lot of time on it. Okay, so I'm going to say that one more time. If you're in construction, your payroll associated with projects should be part of your COGS, cost of goods sold. And I'm going to show you that in one of my reports. Anything outside of a project, meaning my internal bookkeeper, she's not necessarily directly associated with the project. She's overhead. Myself as a president, I wasn't associated directly with the project. I'm overhead. My office manager, same thing. So we were all under a separate code that was an expense code. It was a 7000 code, an expense code, okay, under our overhead and not our COGS, okay? Felicia, can you do me a favor? Can you come move my chat over for me, because I cannot see it at all. So somebody's putting something in the chat and I can't see it. So if you can slide that over for me. All right, so let's go.
It's just me letting you know that I'm going to let Chriselle jump in here because I want her to hear it.
Okay, no worries.
Okay.
Yeah, y'all can share this with whoever. Okay, so let me put something else up. Number 2. So the second step, you want to identify your projected revenue. Identify your projected revenue. Just pick up the whole thing and slide it over, because widening is blocking my screen. All right, so number 1 was the prior year. Number 1, prior year profit and loss report. You need that first. The second thing is identify your projected revenue. So this is where having your a good understanding of what you're looking at. Like, can you evaluate how much revenue you're projecting? Can you tell by how many leads you have in your pipeline what revenue you're going to generate this year? So some of us have a goal, that's fine, but a better way to identify that target or that projection is to say, how much work do I have in my pipeline, and what percentage of this work do I believe I will acquire? Does that make sense? So if I have $1 million in the pipeline, that means I put out $1 million worth of proposals or estimates. What's my percentage of capturing or converting those into actual sales or contracts? So once you kind of have an idea of that, you can kind of understand, okay, I have $1 million in my pipeline, we normally convert 1 out of every 5 proposals. That's 20%. So most likely right now, out of that $1 million in my pipeline, I'm projecting $200,000 in revenue, right? Everybody following the logic so far? Yes, yes, or no? If I need to slow down, let me know. Yes, you all got to talk back to me. Yes, you got it? Okay.
Yes.
Okay. So once I have that, right, and I figured here's my projected revenue for the year. Maybe, let's say right now, I put $1 million of bids and proposals out. I should capture 20% of that. That's about 200,000. Well, what is my backlog timeline? Backlog timeline. I'm going to kind of explain that for a second. That means how long would that last, those projects last? So you got to kind of know your numbers. So you kind of figure, normally I figure 6 months to 12 months out. 6 months to 12 months out. Let me kind of explain what that means. So for an example, if today, as of February, I put out $1 million worth of proposals, I figure I'm going to capture $200,000 of those. Normally, I'm going to say that'll carry me 6 months. Okay? So now I also need to figure, okay, how much more work will I pursue that will pick up through the rest of the year? So maybe I'll say, okay, between now and the next 4 months, right? Because that put me at 6 months, and that gives me another 6 months to the end of the year. All right? So if I say in the next 4 months, I'm going to be able to generate $2 million worth of proposals and estimates. 20% of that 2 million, what? 400,000. So I take my 200,000, 400,000, put them together for the year, 600,000 worth of projected revenue. Did everybody see how I came up with that number? I probably should have put this on a sheet so y'all could see it. I'll go back and do that. All right. So that's kind of how I figured my annual projections. But it has to be some logic towards it. So let's recap. I take my profit and loss report from the prior year. I identify my projected revenue. Now the next thing is I compare my previous year's COGS, cost of goods sold, percentage of revenue. All right, that was a mouthful. I compare my previous year's COGS percentage of revenue. So I'm going to show you on the screen what that is, and it'll be more self-explanatory. Now, Minerva, this doesn't impact your business as much. Okay, so for those in construction, we have COGS that are associated with our projects. And so whatever those costs are associated with your projects, that's your COGS. So that's going to be a percentage of your revenue. Now, I'm going to show you this on the year that we had jumped up to $11 million in revenue, but we lost money that year. I'm going to show you how our COGS had already told the story even before I realized it. Okay? So I'm going to show you this. All right? So let's go to step number 4. Step number 4, after you have compared your previous year's COGS percentage of revenue. What percent of revenue is your COGS? The next step is to project your desired current year COGS percentage. Okay, so let's say, for instance, my previous year COGS percentage of my revenue is 80%. That means my cost of my projects is normally 80% of my revenue. Well, let's say I want it to be 75, because the less it is, the more profit I have the ability to make. The less my COGS are, right, in percentage, the more profit I can make. Giselle, you with me? Okay, so I want to always kind of bring that number down each year if possible. Sometimes it's impossible, but that's the goal, to bring my COGS percentage down. All right, so the fourth step is project your desired current year COGS percentage. Then number 5, use the prior year's overheads amounts and identify changes. Use the prior year's overhead amounts and identify changes. Why is this important? Okay, because it's history. Minerva and I talked about this right at the beginning of this. If your numbers are not being allocated to the right category, it's going to be hard year over year to get this accurate. So you got to clean it up. Once you clean up that 1 year, you make sure you are costing things to the right code. Then now you have a good baseline to start from, and then every following year, every subsequent year, you're able to say, okay, well, our office rent or office lease or office purchase, whatever you want to call it, was 5% of our revenue. That's how much it was, the percentage. It was 5% of revenue. Well, you said, well, if we're going to drive that number down, we maybe say, hey, next year we want it to be 4%. So you're going to do this for all of your expense items, right, for your overhead. We already talked about cost of goods sold. Now we're going to start talking about overhead, administrative costs. So you're going to start looking at those percentages. I had one client, I'll never forget this. I had one client, now reading their reports, and they had, what was it called? It used to be called travel and entertainment. Anybody heard of that cost code before? Travel and entertainment. Or that's where we place all of our food outings, our lunches, our dinners, those type. Anybody have one of those? Okay, I see you, Minerva. Anybody else? Right? So you go out to dinner, you had a business meeting, and you charge, that $100, $200 bill to that. Or maybe you did something for your staff, and you all had a lunch and learn or whatever, and you're charging that food expense to that code, right? So this was last year. I had a client, I looked at it, and the percentage, because I always start with finding the percentages first. Why? Because the bank's going to do the same thing. The banks look at your line items and they look at your percentages to see if they're in range with your industry. Okay? They're going to look at it and see if you're in range with your industry. And so I looked at their travel and entertainment line item. It was 10% of their revenue. I'm like, what y'all doing? I'm like, either you charging the wrong thing to this code or you all eating a whole bunch of food. Like, I know the cost of eggs going up, but come on now, what's going on? So, like, it just stuck out. And so I want to identify what should that percentage be this year, okay? Now, you can always look up reports. There are reports out there that you can find out what are expense percentages for your industry. Expense percentages for your industry. There are different reports you can research and look that up. All right, let's go back. So step number 6, you want to make your overhead adjustments and finalize those percentages. You want to make your overhead adjustments and finalize those percentages. Okay? And then number 7, you want to confirm that the net profit is acceptable. You want to confirm that the net profit is acceptable after totaling your projected overhead and your COGS. All right, so that means once I made all my adjustments for this year, I want to make sure it's my net where I want it. So let's say I do all my adjustments, my net is at 2%. And I say, no, that's way too low. So let's say it has to be no less than 5 or 10. Okay, then I have to go back and find where am I going to reduce these percentages to pick up the difference that I'm looking for on my net. Did you all understand that? All right. No, nobody. Okay, so I'm going to show you all what I mean in an actual example, okay? I'm going to show you all what I mean in an actual example. All right, is this helping anybody?
Yes.
All right, I got one person that's helping.
It's making me want to go back and investigate. So I'm already going to investigate these codes and see if we're in line, because we kind of labeled them ourselves, right?
Yeah. Yep.
And then now, like, I literally just asked Phil to send me the income statement and all that for last year, so I could start kind of seeing.
Yep.
And then we went in and put everything for 2023 as well, so we have something to compare it to figure out 2025.
Yes. Now, for those that don't,
you did great.
For those that don't listen, y'all. For those that don't know, Minerva was my first coaching client. All right, so she's been with me for a while, right? So Kudos. I'm so proud of you. I'm so proud of you. All right, let me show you all a couple steps. I see you said you're a little lost, Giselle, and I know why. You will be easily lost with all of this if you're not in your financials. And it's not an indictment. It's not a negative thing. I want to challenge you to start getting in your financials. Let me say this and be clear. If you are outsourcing your bookkeeping to your CPA, how do you know what they're doing is correct? If you're outsourcing your bookkeeping to your CPA, how do you know that what they're doing is correct? Because I'm telling you, 80% of my clients that I have seen outsourced to their CPA, and I've looked at their statements, it's been incorrect, okay? And so they're like, Michael, you recommend someone? Of course. So listen, if you need a recommendation, you're here in the state of Florida, I have someone for you. All right. But the more in tune I was with my financial statements and reading them, then I could understand some of these principles. And I'm going to show you, I'm going to elaborate, I'm going to give you a real report so you can understand all of these steps that I'm giving you. Because we're starting from, hey, we're no longer just trusting what our bank statement says. We're no longer just trusting just the profit and loss report. Okay, we're also going to compare that profit and loss by having a budget versus actual. A budget versus actual. Why? Because the budget is going to help us know. It's an indicator. Are we going in the right direction? Because otherwise you're guessing. All right, I got you, Corey. We'll put that in there for you, okay? I got you, Corey. So you need to know, hey, am I going in the right direction? I said it earlier. I'm just going to say it one more time. If I'm projecting that $600,000 in revenue, right, how do I know by the end of the second quarter that I overrun my expenses? Because some of us, this is my mistake. Can y'all learn from me, please? Because this will make my life and my purpose way much more meaningful. Please learn from me. My mistake was I had all of this stuff. I had a great CPA, like a real good one, right? I had an internal bookkeeper, but we never put a budget, an annual budget together, even though I had project-specific budgets. And so what would happen every year, we will overrun our expenses, not realizing, hey, now I got to generate that much more revenue to compensate for my overruns of expenses. And I didn't know until it was too late. So if you start putting a budget together at the beginning of the year and say, hey, no, we're overspending right now. We're not where we need to be. Let's cut this now. You're able to respond to these challenges and issues sooner. So you're not at the end of the year like, oh, man, I didn't realize we were doing so bad. Okay, so y'all please listen to Coach Mike, all right? Now, let me see if I can blow this up. So this is an example, Minerva, of some categories. Now, this is not construction, but this is another business. Let me see if I can figure out how to zoom in on this. All right, can you all see that? Is that better? So these are what we call overhead expenses, right? Overhead expenses. So yours may be similar to that, except your codes may be 5,000. It could be anywhere between 5,000 and 7,000. That's the normal codes for any business, between 5,000 and 7,000. Now you can see this is an annual. We had the annual actual cost, and we had what was budgeted. So at any point in time during the year, I could see, hey, are we having overruns or are we under?
What software did you do this in QuickBooks, or this is like a separate, like Excel or something?
This is QuickBooks.
Okay.
Now what I would do is, for the sake of just you having steps, understanding the steps, normally most people use QuickBooks, some people use some other software, but what you want to do, you take your year-end profit loss, okay? You can export that out of QuickBooks into an Excel document. In that Excel document, you can start running your percentages. I'm going to show you all that in just a second, okay? So give me like 5 more minutes. We're going to get to that spreadsheet. right? So I export the report into an Excel document or CVS or XLS or whatever. Then I take that and I start running my formulas to get my percentages. Okay, I'm going to show you that in a second. All right. Once I get my percentages, I know where I was prior year. Now I look at that and say, okay, is this what I want? I identify my COGS percentage. Is that where it need to be? I start looking at each individual line item. Like on this, I start looking at these line items and the actual percentages of each one. Is that where it need to be? So let's say, for instance, I have rent, office rent. I know my rent's going to go up 3%. So I'm going to go ahead and plug what that number is and calculate with that percentage. So I know I have some hard costs I'm going to have regardless. So I'm going to make sure I work on those first. And then I may have some variable expenses that are up and down depending on how I approve spending. I'm going to play with those even more and say, no, we're not going out to eat this year. We're not spending money on food this year. So I'm able to drive that number down, which increases my profit. So as I start working on this budget, I'm starting to look at each line item and placing a percentage, and it all totals to 100. Okay, so this is an example of overhead costs. There are all the different categories we had. You see the ledger account codes on the side with the description. You see actual versus the budget, and at any point in time in the year, I can forecast January, February, are we in line of where we should be? So I can always look at it, because in QuickBooks, you can run the report as the end of February or as of today, and it will say, hey, you should have budgeted, $1,800. You're actually at 19, so you're over right now. So maybe I'm a little bit over. It's not a big deal. But maybe a number like this, where I'm $5,000, uh-oh, that's a red flag. We need to watch this. Okay? Are y'all with me? Make sense? Okay. All right. Now I'm going to pull up my spreadsheet. Any questions so far?
I did notice that the percentage column, the numbers were like over 100% in a lot of the lines there.
So what does that mean? If it's over 100%, I'm overspent.
Yeah, way overspending on a lot of those categories. Okay.
Yep. Now sometimes you'll have that, and then you'll look at your net and say, okay, as long as my net, I'm not overspent on my net, I may be good. But that's why you have a budget.
Because if you're super low on one other category, it might balance out the one that's over.
Right. Gotcha. But here's the thing. After you do this 1 or 2 years, you should know where you should be. Right? And when you overspend on a line item, all of a sudden it's like, uh-oh, we got a problem. So now you picking up on problems. So if you all going to be future millionaires, I need you all to get this. I'm telling you, I promise you this is the largest mistake I made, not having an annual budget every year, right? So if you do this, you're going to pick up on problems. Every month, you should be reading these reports. You should be looking at, hey, are we in line? Are we off? Do I need to pick up more jobs that are more profitable? This will also, it will tell you, do I need to increase my profit margins? What does that mean? Do I need to charge my client more? Because some of us, we're just throwing a number out there hoping it's going to work. And we don't realize we're actually losing money because we're not charging the client enough. This is going to tell you. Are y'all with me? Yes, yes? Yes, yes. Drop a yes in the chat. You still hanging there with, you still hanging with your boy. All right. Okay. I'm going to zoom in a little bit on this. I love Mac computers, but I do not know how to work numbers. Let me see, zoom in. I'm trying to zoom in. If anybody, oh, there we go. It's over here. All right, you all should be able to see that. So this is an exported file from 2017. This is actually like I'm showing y'all the real deal. Like, this not fabricated. These were my actual numbers. Okay. 2017, we did 11.8 million. Okay. Y'all with me? Y'all come off mute so I can hear y'all.
Yes. Yes.
Okay. Okay. So you can see we got my ledger codes, my contract income. Everybody should have this contract income. If you're in construction, you should have a line item called over under billings. I know most of you all don't have that because you're not set up correctly. Right? Okay. I'm not going to explain over under billings today. It's already recorded in the portal. Okay, so I already have that out there. Okay. I've already taught them this. If you need some additional assistance, let me know and we'll work with you on that. Okay. All right. So over under billing. So at this time, I know because this is a positive number, we didn't recognize we have an additional $78,000 of income that we had not recognized yet. We had $78,000 that we had not recognized yet. That means we were underbilled. If we were overbilled, that number would be negative and it will bring our operating income down. But because we're underbilled, that means we hadn't billed the client enough on the pay applications, but we recognized it on the project budget. Okay, we're at 11.8. All right, so that was our revenue. Now our COGS. We call it direct expense, but this is COGS, cost of goods sold. So all the dollar amounts, all the costs associated with the projects. All right, so let me show you. This was all material, some equipment, everything we subbed out, other job expenses for this. This is like dumpsters, portalets, things like that. That's not actually materials going into the building. This was our payroll associated with our projects at the time. And then all of the benefits, payroll taxes that was associated with the payroll. So all of that, look, 11.4, almost 11.5. So this put our COGS at 97.4% of our revenue. What do you all think about that number?
High.
Way too high. Way too high. What do you think it should be?
Probably like 70.
Okay. Anybody else? We got a number 70. Anybody else want to throw out a number? What should it be? Come on, y'all. Talk to me. Corey.
I would say between 85 and 90.
Okay, 85 and 90. Who else? What'd you say, Resdor?
I'll say 75.
75? Giselle, what you say? What number should our COGS be?
I honestly have no idea.
Now, Giselle, okay, we got to work together because I need you to have at least a guess.
I guess it would be between 75 and 80.
Okay, 75 and 80. All right. And then who is that? Minerva, that's one of your staff members. Okay, I'll give her a pass. All right, so listen. There is no right or wrong answer. The right answer is as less as possible. The right answer is as less as possible. Okay, so normally, if we want to say, hey, what's an industry average? Industry average for a construction company. It depends on what type of construction company. Because you have residential construction, you have new construction, you have renovation construction, you have commercial, you have all different types of construction, right? So their business models are different. You have those that are pure construction managers. That means they're passing all of their costs on to their subs, right? They make a smaller margin. So that number is going to be different. So you can't necessarily compare it to everybody. That's why it's important to understand you want it to be as less as possible, but you can look at industry statistics to see what it should be. So I would say.
But it depends too what type of growth mode, right? Like, isn't that like a pretty significant factor? Like if you're in like a pretty heavy growth mode, that you're probably gonna have a lot more expense and maybe some less profitable years.
Okay, so let me explain the difference. I like that you are thinking that way, but let me show you the difference. Most times on
or I'm trying to justify maybe.
No. Stay with me. So most times, let's say you're growing, right? Most times your COGS is only changed. Lord, I hate this thing. Let me see if I can change it a different color. Most times, Minerva, your COGS only change when you sell it at a different price. You see that? So let's say you grow. We grew in this scenario. I think the prior year, I don't remember. I can't remember if we were at 6 million or 4. Okay, all I know, we probably doubled. Okay, we doubled. Normally, your COGS should correlate year over year. They should be pretty close. If they're not pretty close, it's an indicator you have one or two problems. You had an estimating problem, or in your case, Minerva, you all priced it wrong, okay? Or material costs went up from the time that you actually contracted your subcontractors. What do y'all mean by that? Okay, and I know I'm getting real deep and heavy, but I'm just going to do it anyway, and you got to catch up. Okay, what I mean by that is you priced the job to be $100,000. The subcontractor price you thought was going to be $90,000, but it actually turned out to be $95,000. So you lost that $5,000 in your estimate. Between your estimate and you buying out the contracts for the subs, you lost money. So the estimate was the problem. Okay, now just because you grew the next year, that doesn't necessarily change your COGS unless you have an estimate problem. Or number two, you had what's called an escalation problem. That means between the time you bought out that subcontractor, right, your cost for the work, their price went up. And then they roll that price back to you and say, hey, I want you to pay for this, right? So sometimes that happens. Or here's another scenario. Or that contractor, you had to kick them off the job and have to hire somebody else, and there was some additional costs you had to spend to get a better contractor to finish the job. So maybe you had to pay more money because of that. That's not directly correlated to your growth. That's correlated to two other issues that could have happened. That makes sense? Okay, now to your point, Minerva, I just want to clean this up. To your point, there's a difference between COGS and overhead expenses. Okay?
Yeah, I got that. Yeah, I was thinking of the COGS as, in my business, all of the expenses of growth, like so, advertising, marketing. Yeah, so but your COGS is cost of sold.
Right.
Goods sold. Got it. Yeah.
So
you took me back to Mac.
Yeah. So I give you an example. In the insurance business, your costs would be any costs associated with actual premiums. Right? And then all your overhead would be all these other items. So what Minerva's speaking to is, let's say, hey, I doubled in growth. My office size just doubled. So now I'm paying more rent than what I paid previously. Right. Yeah. More payroll, more rent because of that growth. Well, I should have projected that here in the next year. So I would take the percentage, these percentages, whatever this is, and I'm always going to divide it by my revenue, my total revenue. Okay, so whatever that number is, so this is a real small number. And again, I hate using numbers, but I had to use this computer. Let's see. Whatever this number is, I don't even know what it is. It's probably like 0.5% or something like that, or 0.2%. It's not even a percent. Okay? It's not even a percent. All right? So it's a real small number. Just like you see here, I had already did it here. This $300,000 is 2.6% of the total. Right? So I know it's less than 2.2 because this 25,000 versus 300. So that's why this didn't show up right. So what I do, I take all of my numbers, all of my costs, and I do a percentage. This divided by the total revenue. Right? And I do it all the way down. All the way down. So every year, if I'm using these same ledger codes, if I'm using the same codes every year, then I'm playing with those percentages. So for this, my overhead was about 2%. Right? Y'all see that? So my gross profit is 2.6. My overhead is 2. That leaves me at what? 0.6 profit. That's horrible. It's not even a percent. And then I had additional administrative expenses, which was my salary. So this is where I broke out my overhead salaries down here. Right? That was another 2.7. So we lost money. All right? So I'm showing you all where I lost money. Now, the good thing is we would have lost $244,000 that year. But because I had a joint venture, you all haven't, if you haven't heard me talk about that, it's on the podcast last January. I talked about this, having partnerships and joint ventures. We profited $90,000, $95,000, which helped bring this number back up. So that's why it's good to have partnerships, joint ventures, because that's money that's going to just hit your bottom line and help your numbers. Okay. So we still had a negative year this year, even though we did $11.8 million in revenue. Now, I'm telling you this happened because I wasn't doing what I do now with these things. I actually take all of these percentages and I say, okay, just like Corey said, well, why was I at 97%? So I started investigating this number. Did I take a loss on jobs? Like, what happened? Because really, this number maybe should be like 85% if you're a CM. If you're doing like residential, or if you're a subcontractor like Giselle, let's talk about your situation for a second. You're a subcontractor. So let's back into this. Okay? What percentage of profit would you want to make every year? What percentage of profit would you want to make every year?
15 to 20.
Okay. So 20%, let's say 20%, right? So it all adds up to 100%, right? So that means if I'm going to make 20%, I only have 80 to play with. So can my COGS be 80%? My cost of goods sold, which is directly related to your projects, can it be 80%? Who has the answer?
No.
No. It has to be lower than that. Why? Because I have all this overhead cost.
Other expenses.
Right. So that's why it's good to know what your overhead is running every year. So let's just use my number. All right, yours is going to be different, and you need to go investigate that. So just my pure overhead without salaries was 2%. That's actually a really good number. So if I add this with my other salaries, I'm at 4.7% just with payroll overhead and expense overhead. That's actually a really good number. So let's just say yours is 5. Let's just say 2.5.
Okay, go ahead and cover.
Let's just say 2.5 and 2.5, right? That leaves me with what? I got 2.5 here for my overhead and expense. I got 2.5 for my overhead payroll expense and 20% for profit. So that's what? 25?
75% left.
Right. So that means my COGS cannot be any more than 75. Are y'all with me? And guess what? That's regardless. Stay with me. Regardless of what my revenue is. That boy be teaching. That boy be teaching. I can't get nobody else. That's all right. I clap for myself. That boy be teaching. Right? So, regardless of what my revenue is, it doesn't matter. I want my percentages to hit my percentages. Some of us, I had a student last year in a class that I taught, and his revenues were down 50%. He went from $5 million to $2.5 million in revenue. And he was bummed. When I tell you he was bummed, he was like, I lost $2.5 million since last year. I'm looking at his financials. I'm like, bro, you profited $150,000 the previous year, and you still profited $155,000 this year. What you talking about? He was like, but I did $5 million in revenue the year before. I'm like, it doesn't matter. Look at your percentages. You made more money off. You made the same amount of money off $2.5 million that you made off $5 million. You should be taking that all day. You know, it's really understanding the numbers. So now that you have an idea, let me start with the percentages, regardless what the revenue projection is. Okay, so y'all remember I gave you the steps. Okay, step 1, pull your profit and loss for the prior year. Step 2, you want to start identifying what's my projected revenue. So in this scenario, we use $600,000, right? Was the number we figured as our projected revenue. So I would take 75% of that and say, okay, whatever, somebody do the math. Let me do this because I hate numbers. I hate this software. And I'll probably, let's see if I can figure it out. Let's see. So
what's
that
the numbers again?
It's right here. I got it. So
okay.
My projected revenue that we was talking about earlier in the session was $600,000, right? We was talking about that earlier. If my cost is 75%, that means all of my project costs cannot exceed $450,000.
$450,000.
Right? So over every month as I'm incurring costs, I should be checking my percentages or checking the numbers, right? If you're in QuickBooks, it's going to tell you. Once you load a budget, it'll tell you. So first of all, get your percentages down. Second of all, convert those percentages into numbers. Then you're going to put those numbers into the budget in QuickBooks. So QuickBooks, depending on what version you're on, you can actually set up your budget. So then you can run a budget versus actual report like I showed you all in that previous document. All right? Because you'll always run that report. So every month when you're looking at your numbers, you're looking at your actuals. Because some of us do that. We look at our actuals. But now, look at a budget versus your actuals. Now you can project. Are we doing good or not? Does that make sense?
Yeah. Because it'll let us know, too, as we're making decisions throughout the year, can we afford it according to the plan? Exactly.
And some of us, we need that because we'll just think, oh, we made money this year, we good. And we're like, well, we're not looking at the long term down. I'm telling you all, this is one of my biggest mistakes in business. I did everything right, just didn't have a budget, an annual budget. Let me be specific, because I had project budgets. Every project had its own budget. So I could track whether that project was losing money, but I never really tracked until the end what the company was doing what I wanted it to do.
So the correlation between the two together, how they were affecting one another.
You know, and Minerva, for you, the biggest area for you to really look at is your overhead, you know.
Yeah.
And, you know, because I know that, let me caveat that with this. You will be able to draw a baseline of what profits you should be generating, but you may look at that percentage and say, hey, I really want to make more than that. And so what you may end up doing is saying, let me play with the market for a second and maybe increase my margins, which means I'm transferring that cost to the client. And let's see if I'm still selling at the same rate. And if I'm able to...
the expenses are going up.
Yeah, if I'm selling at the same rate, right? If I'm selling at the same rate, meaning my conversion rate is not changing because I increase my prices, keep going. At least you know, hey, I'm still capturing and converting clients. It's not affecting my revenues. I'm good. That means I should be having more money at the bottom line if I'm not spending more. If I manage my expenses, I should be increasing my profits. Okay? Now, if I notice that my capture rate is coming down or my conversion rate is coming down, then I may say, okay, I may need to shift back down because this is a real number. And then you have to make the decision at that point, am I okay with having less revenue and higher profit? Or are you more focused on driving the revenue number up? You have to make that decision. Every business owner has to make that decision for yourself. Okay, but every bank, they're looking at your profit margins, period.
Yeah, I was just going to say, why would I ever be concerned? Well,
it depends. Let's take.
I feel like I would be concerned. I mean, it's so crazy because I am very, very concerned with revenues. It's kind of like my goal, my target, right? It's always driving it up. Wow. Okay, I'm answering my own questions.
Yeah, it's good. But let me give you another scenario. There are other companies that have a different strategic approach. They prefer to drive volume, right? Just like my friend Scott Moss that came and spoke to us last July, billion-dollar company doing $3 billion worth of work, but they operate at a 1% margin. 1%. I'm like, sheesh. For most of us, we can't operate.
The speaker for the mansion?
Yes.
Okay.
Like, they're a $3 billion company, okay? And so when you talk about billion-dollar companies, their margins are often a lot smaller, but the volume of dollars they're making is so much larger. Guess what they do differently than most of us? They manage risk a lot differently. So what they do is they put in risk management, whether it's insurance, whether they're scrutinizing who their vendors are. That's why sometimes it's hard to work for them because they are minimizing their risks, so they guarantee that 1%. They're like, this 1% is guaranteed. Like, we're going to make this 1%. Because they're going to manage their risk and ensure they don't have a loss. Whereas the rest of us, we can be at 5%, take a loss, and we're in the red. So it just depends on your strategic plan. Most billion-dollar companies do operate at lower margins. I'll just say that. Okay. Mm-hmm. But you should try to get the highest margin you can get. All right. Questions. All right. Let's recap. Giselle, I know I lost you a couple times. You have any questions, Giselle? I see you in the chat, Corey. Thank you for that.
It's questions, but it'll take too long to answer.
Well, give me one question.
It's no, because like you said, I'm not familiar with my financials.
Okay.
That part of it I've never been good at. So to ask the questions wouldn't make sense unless I'm looking at my financials directly.
Okay.
Or I can have specific questions. So I will get back to you on that.
Okay. Sounds good. And I think that will help a lot. I think using a spreadsheet like this will really, really help you. So make sure everybody should get your, all of you all have been in business. So export your profit and loss statement. If you don't have access to this, make sure your CPA give you access, right? Don't just rely on them doing it. You should have your own access. If you're doing your bookkeeping in-house, okay, start working on make sure you're costing things correctly. Okay.
I know Chriselle just told me we have to add that budgeting. She said we don't have Chriselle, she said.
Yeah.
the budgeting is not part of our plan.
Yeah, that's pretty normal.
To find out how much it is.
Yeah, it's not a lot.
And the coding too.
Yeah, it's not a lot more, but I found most people are not on that level subscription. Most people aren't. In the same way.
Yeah, no, we want it because we want it all in the same. Like, I don't want to have to like go into another program, and it's just if they can provide it and if it's already there and they can speak easily to each other, we're gonna do that. Hey, before we are finished, could you guys send me that email that you guys sent me? I think it was like towards the end of last year for like different packages and stuff like that. And I know there was like your offering, and then it was like also to like this you could customize.
Yeah.
So, you know,
yeah. So for you, Minerva, we'll do something different because you're not a construction contractor. So we'll just set up a meeting. We'll
I'm gonna work on this with yourself, but I really need you to look at this for me, and maybe a few other things. So if you could just.
Okay.
You know what our next steps are, so maybe something I'm not even thinking about yet, you know, and then I could just kind of have a catch up call with you and review and all these type of things because
Okay, good. Good.
Awesome.
Sounds good. Awesome. Sounds good. All right, I'm glad you were able to learn from this. Now Giselle, I want you to talk like Minerva in about 6 months, okay? Because I promise you, one session with you, especially Giselle, if you're in, do you have access to your own system, to your own QuickBooks or whatever platform?
Yeah, I have.
Oh.
Yes, I do.
All right, so I'm telling you, in an hour, I'll have you driving that thing, and you're like, wow, I didn't realize I could do all this. And literally in an hour, I'll show you what to do and how to set it up. So for some of you all, just to also know, on the construction side, just like Minerva mentioned, to get the actual numeric codes set up with your ledger accounts, it's an additional subscription or a higher subscription. Normally with that comes the ability to set up budgets and then also projects. So if you want to actually itemize your projects, some people use project management software to do this, but you can also do it in QuickBooks. So either way works, as long as you have the capability of doing it. But you will also be able to itemize your project costs and track your project costs and have separate project budgets as well. And normally that's just one upgrade for all of that. So just look into that on the QuickBooks side. I can't remember how much it is. So, but anyway, hopefully that helps. All right, Resdor, do you have any questions?
No, we just had to. I just probably want to meet with you so we can brainstorm on on a few things. Because I was like busy setting up systems and stuff like that, and getting stuff together. So whenever you have time.
Okay. All right. We'll make sure everybody have my calendar link, and you all can just schedule your meetings. Okay.
Okay.
All right, Corey. Any questions, Corey?
I really have one question. Just figuring out like the revenue, the pipeline.
Yep.
What's the, I don't know if I want to say what's the best way, but just figuring out, you know, because I use, Plan Hub to kind of look at what's coming out as far as subcontract work that I'm working on right now. Okay. What's the best way to go about building that pipeline, knowing like what I should be looking at as far as
I love
coming up with the revenue.
I love that question. Thank you. All right. So this is what I teach and hate to say, but preach. Stop just bidding jobs just to bid them. Okay, I tell every client that. Don't just bid jobs just to bid them. You're just throwing things against the wall to see if it's going to stick. If you don't have a relationship, most likely the only way you're going to win that project is if you're low. If you're low every time, what is the chance of your sustainability? It's very low. Why? Because you probably have low profit margins, right? And so the thing is, or you could be in a position where you lose on a job, then you're out of business. So I teach a specific strategy, right, in formulating your strategic plan. Okay, Corey, you got access to the portal. So I just need to meet with you and say, hey, bro, go look at this video, go look at that video, and I give you 3 or 4 videos that's already in the portal that's going to answer specifically your question in detail. But let me give you the short answer. All right? The short answer is this. What's the low-hanging fruit? Low-hanging fruit. Number one, I tell everyone in the construction business, you should try to find somebody else to partner with. That's the low-hanging fruit. When you partner with someone as an associated partner, right, Giselle, I want you to do the same thing. You have no risk at all. And it's kind of like a mentoring kind of thing, right? They need some diversity participation, or maybe they have desires of helping a smaller firm out or whatever. You know, things have changed with, you know, new administration or whatever, but there's still people in the world that's still looking to mentor smaller firms. So you want to first look for partnering arrangements where you can be on the job or put a staff person on the job and also maybe get some profits out of the job and have no risk associated. You're just clearing money. There's contracts coming in your door. Also, you're building a resume. You have experience doing a project like that. So that's one way I tell everybody. You got to do that. And that should be based on relationships. The second low-hanging fruit is, what is your experience? What does your resume say already? Right? This is my 3R framework. Resume, relationships, and resources. Financial and human. Okay, so when we're talking about your resume, what projects have you done to date? Even if it's not under your company, maybe it's who you worked for before and the projects you worked on for somebody else. That's still part of your resume. So what experience do you have? Is it retail? Is it hospitality? Is it healthcare, aviation, education? Like, what is that? So you got to put some type of resume together to say, hey, I have experience doing this, right? Because people do business with those they like, know, and trust. So first of all, you got to build relationships, okay? You got to build relationships. So if you're just sending out proposals, sending out estimates, guess what? They're looking at it and going to someone else they know and saying, hey, can you do it for this price? So if you're just throwing out proposals, I promise you, you're wasting your time, and most likely you're only getting those jobs because you're low. You want to be able to get a job because you weren't low, but you had a relationship. Okay? So that's kind of like a couple different strategies I'm giving you right off the cuff, right? That you should put in place. So you need to identify, like Giselle, doing drywall and stuff like that. Well, okay, there are people doing drywall in residential, people doing drywall in commercial, government. Like, specifically, what is your space? What's your niche? Then you're going to look, okay, who are the people that have work in this niche? Then you're going to start saying, okay, how can I start developing a relationship with them? Well, where do they meet? Where do they frequent? What networking events do they attend? Because you want to start being strategic with your marketing. This is now how we cross over into marketing. How am I going to reach them? Am I just going to send a blind email to them, think they're going to read it? Nope, they're not going to read it. They're going to ignore it. So until you get in front of them, say, hey, I'm Michael, I'm going to follow up with the email. Sometimes they still won't. But the more and more they see you, oh, Michael, I just saw you at this event, now I see you at that event. And then they start to get to know you. Then maybe you set up a meeting and say, hey, I want to see maybe I could do a lunch and learn or whatever it is. And over time, you develop that relationship. Now, they begin to like you. They begin to know you. And not until they give you that first job can they really say they trust you. Then you have to perform once you get that first job. Once you perform and they like you, they know you, that's it. It's a wrap. You will get another one. So that's how you kind of start. But you got to start with those strategies, okay? So in the portal, Corey, I need to show you all of those sessions where I talk about the marketing. So if you go on the portal, look under Revenue Disruptor Mentorship. There's a couple categories on the main page. You'll see categories that has the dates for the marketing piece. You need to go there because I talk about your client strategy. Okay, I want you to watch all those videos, okay?
Okay.
But that'll help you a lot. You know, I know that'll help Giselle as well because, you know, too many of us, we're all over the place. We're just trying to get a job. I just need a job. That's not the way to do it. You're wasting a lot of time and energy. That goes back to what you mentioned, Minerva, at the beginning, that book. You know, the 12.
Go for the no. Oh, the 12-week year?
Yeah, the 12-week year.
Yeah.
That's how you become more strategic with your time. You know?
Yep.
So, all right. Anybody else with a question? I'll take one more question before we wrap up.
I don't need to do a strategic call, right? You're just going to send me something?
Let's do a call, and then I can see exactly what you want, and then I'm sure whatever I do is going to be customized. So.
Got it.
Okay.
Okay.
All right.
Already scheduled.
All right. Anybody else? Well, let me pray over you, which is my custom. And if you would say this prayer, don't forget, if you would like to join me for Journey, let me see if we can put that back up. Baby, if you can drop the link for Journey, pmdy.link/journey. If you want to take a look at that, the Christian Education and Leadership Program, if you're looking to grow, being more tuned spiritually and grow your relationship with God and the things you're doing, sharpening your leadership skills, join me in this course. I'll be teaching this 8-week course. Very inexpensive, very affordable. So I want you all to sign up for that if you can and join us on this journey. All right. So let me pray. Father, we say thank you for this opportunity to come before you to learn more about business and sharpening our business skills and our knowledge and awareness of financials and budgeting and preparing for what's next. And I pray for each person that's on this call, each person that will watch this replay. And I ask, God, that you will continue to expand them, grow them, but most importantly, keep them during the tough times. Help them to persevere and overcome each and every challenge. Continue to help them make wise decisions so they don't make too many errors and too many mistakes. And I just pray that you bless them exponentially and open up great doors for them, opportunity. Show them who to talk to, which relationships are good relationships, and also which ones are bad. And I just pray for each of them that they will continue to get closer to you. And we just say thank you for all these things in Jesus' name. Amen.
Amen.
All right, family. God bless you all. We'll see you soon.
All righty. Take care.
All right.
Bye-bye. Thank you.
All right. Bye-bye.
Bye.